The Santa in this rally is not a benevolent bringer of gains, but a potential trickster figure, and the script's first key point is a loud, clear warning to check the sleigh for hidden traps before climbing aboard. In the framework of the script, all market roads ultimately lead to the marble hallways of the Federal Reserve. The selection of the next chair is not merely an administrative appointment. It is framed as the central plot point for the 2026 financial story, a decision with the narrative weight and market-moving potential of a geopolitical event or a seismic shift in monetary doctrine. This elevation of a personnel decision to ultimate catalyst status is built on several interconnected layers of analysis. First, the script establishes that the macro battlefield is already set. Yields are rising globally, in Japan due to rate hikes, in Europe due to fiscal concerns, creating a backdrop of tightening financial conditions. Against this global tide of hawkish pressure, the United States, and specifically the Federal Reserve, stands as the outlier. This positioning makes the Fed's every move disproportionately significant. It is the lone major central bank whose policy trajectory is seen as the most uncertain and therefore the most powerful lever for global capital. The decision of who will pull that lever inherits this immense gravity. The analysis then masterfully shifts the debate from the what of policy to the who of personality and political dynamics. The script moves beyond dry speculation about rate cut timelines and into the more nuanced realm of power, persuasion, and committee psychology. It cites a crucial insight. The chair alone can't command rate cuts. They need the committee's vote. This single sentence reframes the entire selection process. The ideal candidate is no longer just the person with the most dovish or hawkish resume. It is the most effective convincer, the most skilled political operator within the technocratic arena of the Federal Open Market Committee. This transforms the Fed chair from an autocratic policy setter into a consensus builder under siege. The script vividly paints the intense political pressure emanating from an election year, where fiscal spending is already high and the electorate is suffering from an affordability crisis. The incoming administration, regardless of party, will have a powerful, politically motivated desire for lower rates to stimulate the economy and appease voters. The new chair will thus be caught in a historic vice, squeezed on one side by political demands for easier money, and on the other by the committee's institutional mandate to fight inflation and its potential reluctance to be seen as politically subservient. Therefore, the strategic choice for the administration becomes a fascinating game of political chess. Do they appoint a known loyalist, a Kevin Hassett figure, which might spook markets fearing a politicized Fed and harden the committee's resistance? Or do they appoint a respected institutionalist, a Waller-type figure who has the credibility to shepherd the committee toward cuts, but may be less pliable to direct White House pressure? The script suggests the administration may be learning toward the latter, opting for a chair who can bring it back to neutral and wield influence through credibility rather than coercion. This leads to the core thesis. A 2026 market will be dictated not by a pre-written policy script, but by the pace and credibility of persuasion. A chair who can quickly build consensus for a cutting cycle could unleash a violent, liquidity-driven rally across risk assets, including crypto. A chair who fails to unite the committee, leading to public dissent and policy paralysis, would create a different kind of volatility, one marked by fear, uncertainty, and potentially a stronger dollar that crushes speculative assets. The market's trajectory becomes a function of interpersonal dynamics and bureaucratic politics, making it extraordinarily difficult to model with traditional analysis. The script implicitly argues that this decision is more consequential than any single economic data point precisely because it sets the tone and velocity for the entire year. GDP prints and PCE reports will come and go, causing weekly ripples. But the chair defines the enduring current, the directional bias of liquidity that will either lift all boats or leave them stranded. For cryptocurrencies, which are hypersensitive to global dollar liquidity and risk appetite, this current is existential. A dovish, coordinated Fed could be the rocket fuel for the next leg up. A fractured or stubbornly hawkish Fed could extend the crypto winter indefinitely. Thus, by positioning the Fed Chair decision as the ultimate catalyst, the script does something profound. It tells the viewer to look past the daily noise of charts and headlines and focus on the single human drama that will determine the rules of the game for 2026. It's a recognition that in a world drowning in data, the most important variable is now judgment, the judgment of the person in the chair, and their ability to command the judgment of the committee. This is the nerve center of the modern market, and the script places its analytical finger directly on that pulse. The script's core advisory philosophy is not merely a tactical suggestion, but a profound call for a psychological and strategic metamorphosis. It urges a deliberate, disciplined pivot away from the dominant market emotion of the last cycle, greed, characterized by FOMO, fear of missing out, maximalism, and the relentless pursuit of momentum, and towards a new operational mode, preparedness. This is framed not as a passive, bearish stance of hiding in cash, but as an active, aggressive state of readiness, where the primary goal is not to capture every percent of an upswing, but to possess the ultimate financial weapon for a volatile era, strategic optionality. This shift is first justified by diagnosing a critical change in the market's personality. The script observes that the market is becoming more discerning and selective. The era of a rising tide lifting all boats, especially in the cryptosphere, is presented as potentially over. The incoming structured capital from Wall Street is portrayed as discriminating, likely to flow only into top-tier institutional-grade assets like Bitcoin and possibly Ethereum, while abandoning the vast altcoin ecosystem. This creates a bifurcated reality where broad, greed-driven, all-season bets become dangerously obsolete. Greed in this environment leads to concentration in the wrong, illiquid assets just as they face existential neglect. Preparedness, conversely, means having the dry powder and mental clarity to focus capital where institutional validation and liquidity will be. The principle is crystallized in the script's central shareable maxim. The smart money isn't chasing momentum, it's preparing for volatility. This single sentence encapsulates the entire philosophical shift. Chasing momentum is the action of greed. It is reactive, emotional, and often late. It involves buying the top of a move in a desperate attempt to participate, exemplified by the retail trader who sees a headline about a Santa rally to 120K and panic, buys at $90,000. Preparing for volatility, however, is the action of preparedness. It is proactive, analytical, and patient. It involves structuring a portfolio not for a single bullish outcome, but for multiple potential futures defined by sharp up and down movements. The script provides a concrete masterclass example of this shift in action with its discussion of gold. Gold is not presented as a static, safe haven buy and hold asset. Instead, it is analyzed through the lens of preparedness. The analyst notes they have held gold for months and are now considering taking my first profits. Why? Because gold has hit historically overbought levels. This is a preparedness-based exit. It is not driven by a belief that gold's long-term story is broken. Peter Schiff warnings are even noted, but by a disciplined recognition of extreme short-term market positioning. The greed move would be to listen to the $6,000 gold and $100 silver hyperbole and hold for more, increasing risk for diminishing reward. The preparedness move is to harvest gains from an overcrowded trade, thereby converting paper profits into the ultimate tool, cash reserves. This is the crux of the strategy. The cash reserve is not idle money, it is potential energy or strategic ammunition. The script explicitly links this action to the next preparedness maneuver, reallocating some gains into depressed assets like select cryptos. The cycle is thus completed. Take profits from an asset in an extreme bullish consensus, greed's peak, and systematically reallocate that capital into assets in an extreme bearish consensus, fear's trough. This is the essence of contrarian preparedness. Furthermore, the script advocates for this preparedness to be tactical and non-dogmatic. It endorses a swing trading approach for this environment. This is critical. It admits that in a sideways, volatile, and discerning market, the long-term hodl mindset of the last bull run may be suboptimal. Preparedness here means agility, being willing to take shorter-term profits, selling into strength to replenish the cash reserve for the next opportunity. It acknowledges that profits exist even in sideways markets, but that capturing them requires the discipline to exit, a discipline that is the antithesis of greedy diamond-handed mentality. Finally, this shift is framed as a direct response to the identified anger phase of the market cycle. In the anger phase, the market's primary function is to inflict maximum frustration and pain on the greatest number of participants. The tool it uses to do this is volatility traps. Sharp rallies that reverse the suspected Santa rally and violent dips that shake out weak hands. A mindset of greed is perfectly designed to be devastated by this phase. It buys the rally and sells the dip. A mindset of preparedness armed with a cash reserve and a plan for defined accumulation zones, like the mentioned $70K Bitcoin area, is designed to exploit it. It views the dip not with terror but with opportunity. Therefore, the urge shift is a complete rewiring of the investor's operating system. It replaces the emotional engine of greed with the analytical framework of preparedness. It trades the goal of being fully invested in the next moonshot for the goal of maintaining maximum optionality to exploit mispricing. In the chaotic, politically charged, and institutionally driven market of 26 that the script outlines, this shift is presented not as a wise choice, but as a necessary condition for survival and success. It is the move from being a passenger jerked around by every market whim to being a poised strategist with reserves, a plan, and the patience to let volatility come to you. In an analysis dominated by macro pressures, Federal Reserve intrigue, and cold technicals, the script introduces a seemingly soft, yet profoundly powerful variable. It posits that the decentralized, participatory ethos of cryptocurrency has forged a unique sociological asset, a tribal and passionate grassroots community that functions as a formidable defensive and offensive army. This cultural dimension is not presented as a mere curiosity or a branding footnote. It is framed as a critical strategic advantage in the coming battles of 2026, one that traditional sectors like artificial intelligence conspicuously lack. The argument is built through a compelling contrast with the AI industry. The script concedes that AI technology is ubiquitous and beloved by users. However, it makes a sharp distinction between the technology and the corporate entities that control it, OpenAI, Anthropic, etc. These companies, it notes, have very few public defenders. Their support base is narrow, confined to venture capital investors and their own employees. This creates a critical vulnerability. They are bureaucratic, centralized entities that are perceived as serving the interests of a wealthy technocratic elite. In a climate of rising populist anger over job displacement, affordability, and corporate power, these companies stand politically exposed. As the observer in the script notes, if regulatory or political headwinds intensify, the everyday person might not be on the side of the big AI companies. Cryptocurrency, despite its own complexities and factions, is presented as the structural and philosophical antithesis to this model. The script identifies the foundational genius. Crypto's genius was making everyone an owner from day one. This is the core of its cultural power. Ownership is not a privilege reserved for Silicon Valley insiders or accredited investors at a late funding round. It is a feature accessible to anyone with a smartphone and an internet connection. This early broad-based distribution of both tokens and, by extension, economic stake does something remarkable. It transforms users into stakeholders. A person holding even a fractional amount of a cryptocurrency is no longer a mere user of a platform. They are a shareholder in its network with a direct, albeit small, financial interest in its success and perception. From this ownership flows the army. This stakeholder class, numbering in the hundreds of millions globally, becomes a distributed, motivated, and highly engaged defense force. The script vividly describes this dynamic. If someone says something negative about Bitcoin, you just have an army of retail people that just take the knives out. This is not just online bickering. It is a form of decentralized public relations, meme warfare, and political lobbying. It represents constant, organic pressure that shapes narratives, counters FUD, fear, uncertainty, and doubt, and creates a palpable cultural momentum that no centralized corporate marketing budget can reliably manufacture or control. This cultural strength is framed as a crucial shield against the number one existential threat to the space: regulatory overreach. The script implies that when crypto faces a regulatory challenge, this army mobilized. They write to legislators, they amplify pro-crypto legal analyses, they vote with awareness of crypto policy, and they create a noisy, visible political constituency that politicians cannot easily ignore. In contrast, when an AI company faces a regulatory threat, who marches? A handful of lobbyists and lawyers, the public who may use ChatGPT daily but have no stake in OpenAI's equity, is likely indifferent or even supportive of reigning in a powerful corporation. Crypto's cultural army, therefore, provides a layer of political resilience that pure technology, divorced from broad-based ownership, simply cannot buy. Furthermore, this cultural cohesion is identified as a potential accelerant for the next phase of growth. The script hints at crypto IPO coming out next year. A project launching into an ecosystem with this pre-existing passionate base has a monumental advantage. It doesn't need to build a community from scratch. It can tap into the latent energy and tribal networks of the broader crypto culture. The army can provide initial liquidity, narrative support, and developer attention, creating a launchpad effect that is the envy of traditional startups. However, the script is careful not to romanticize this entirely. It acknowledges this tribalism can be a detriment, likely alluding to maximalist infighting, toxic polarization, and an inability to self-critique. Yet, the overall verdict is that its strength outweighs its weakness. In the high-stakes, politically charged environment of 2026, where the script has already established that policy will be driven by electoral pressure and cultural narratives, this hidden strength becomes a primary strategic asset. Ultimately, this keynote argues that cryptocurrency's most valuable innovation may not be its blockchain, its tokenomics, or its DeFi protocols, but its socio-economic model of mass, early ownership. This model has accidentally or deliberately engineered a human network of unprecedented scale and motivation. While Wall Street analyzes balance sheets and the Fed scrutinizes inflation data, this cultural army operates on a different plane, the plane of memes, narratives, and political will. In the battles for mainstream adoption, regulatory clarity, and narrative supremacy that will define 2026, the hidden strength may be the decisive factor that allows the crypto ecosystem to withstand pressures that would crush a more traditionally structured technological revolution. It is the soul in the machine, and the script identifies it as a powerful, underappreciated signal. Beyond the charts of Bitcoin and the halls of the Federal Reserve, the script identifies a deeper, more visceral force shaping the entire financial and political landscape, a profound and worsening crisis of economic affordability. This is not presented as a secondary social issue, but as the foundational, inescapable reality, the real economy that functions as the primary engine for everything else. The market movements in crypto stocks and gold are framed as mere symptoms flickering on the surface, while the affordability crisis is the tectonic plate shifting underneath, determining the direction of policy, politics, and ultimately capital flows in 2026. The script grounds this crisis in stark human-scale statistics that bypass abstract economic jargon. A record 9.3 million Americans now hold multiple jobs. This figure is not just a number, it is a narrative of exhaustion and strain. The script emphasizes that this represents an increase of almost 4 million since 2020, directly tying the problem to the post-pandemic economic timeline and implicitly questioning the narrative of a great economy. Furthermore, it highlights that 5.3 million of these individuals are working a primary full-time job and a secondary part-time job. This data point paints a picture not of entrepreneurial hustle, but of necessity, a desperate attempt by millions to simply keep pace with the rising cost of living, a race that is being lost. This empirical reality is then connected to its psychological and political consequence: sentiment. The script cites that 45% of Americans now blame high prices for poor financial conditions, a level of discontent comparable to the peaks of the early 1980s. This is a devastating indictment. It means that for nearly half the population, the dominant economic experience is one of erosion and frustration, not growth or opportunity. This sentiment, measured by surveys like the Michigan Consumer Sentiment Index, is the fuel for political volatility. When the script states this will dominate the election narrative, it is making a cold, analytical forecast. Politicians do not campaign on the M2 money supply, they campaign on kitchen table issues. And in 2026, the kitchen table is where families are calculating how a second job will cover groceries and rent. This crisis becomes the real economic engine because it dictates the boundaries within which all other actors, the Federal Reserve, the administration, Congress, must operate. It creates an inescapable political imperative for intervention. The script hints at this, asking if the situation could be corrected by some stimulus of some sort from the administration that kind of pushes it forward. This is the critical link. The affordability crisis generates immense bottom-up pressure for fiscal action. Direct payments, expanded credits, student loan forgiveness, or other forms of government support designed to put money directly into strained household budgets. This fiscal imperative in turn collides directly with the Federal Reserve's mandate. Here lies the central tension for 2026. The Fed, wary of reigniting inflation, may desire a restrictive or neutral policy stance. However, the political system, responding to the engine of voter anger, will be demanding expansive fiscal policy to alleviate the crisis. The script's earlier analysis of the Fed chair as a consensus builder under intense political pressure finds its source right here. That pressure is not an abstract concept, it is the collective anxiety of millions of multi-job holders. This sets the stage for a major policy error, as foreshadowed by commentators like Peter Schiff referenced in the script, a scenario where stimulative fiscal policy and necessary monetary policy work at cross purposes, potentially leading to stagflation or new asset bubbles as liquidity is pumped into a supply-constrained, demand-frustrated economy. For the cryptocurrency and broader financial markets, this engine drives two primary outcomes. First, it ensures sustained volatility. Policy will be reactive, politically motivated, and potentially contradictory, creating a whipsaw environment for interest rates and the dollar. This volatility is the preparedness playground the script advocates for. Second, it reinforces the search for alternative stores of value. When trust in the central bank's ability to preserve purchasing power erodes and when traditional paths to prosperity feel blocked, assets perceived as outside the system, whether gold, Bitcoin, or other cryptos, gain appeal not just as investments, but as acts of financial protest and self-preservation. The crisis makes the narrative of decentralization and sound money resonate on a deeply personal level. Therefore, the affordability crisis is the ultimate macro signal. It is more reliable than any technical indicator because it measures the lived experience that will dictate political power. It explains why the Fed cannot operate in a vacuum, why fiscal largesse is likely inevitable despite the debt, and why the public's hunger for financial alternatives will only grow. The script concludes that 2026's market will not be a pure story of corporate earnings or technological adoption, but a story of political economy, of how the state attempts to manage this pervasive economic pain. To ignore this engine to focus solely on crypto's hash rate or a company's PE ratio is to miss the fundamental force that will bend all other trends to its will. The real signal of today is the sound of millions adding up their bills and coming up short, and that sound will echo through every trading floor and congressional hearing in the year to come.